Welcome to the Landlady Boss Podcast. I'm here with my sister and co-host Rachel. Hello, Rachel. How are you doing?
Hi, hello, Marie.
We are here with a special guest today. I have Kim Butler here, and she is a financial strategist, a podcaster, author, and alpaca farmer. And she's here going to be talking about different streams of money for rental properties and how you can keep the cash flowing with your rental property portfolio. So we're really excited to have you here today, Kim. Thanks so much for joining us.
Absolutely. It's a joy to do.
Yeah, tell us a little bit about this alpaca farming thing. I can't let that go without at least acknowledging it.
Well, for those that are watching the podcast, I'll do a little show and tell. So alpacas are a real thing. They are, yes, they're this fuzzy. Yes, they are this soft. They are out there in the pasture, and we mostly use them for rugs and shearing the fiber and having it spun into yarn. My crocheting ability is square or rectangle only. So
That's more than mine.
well, yes, and it's limited. And we got them mostly just to legitimize our agriculture exemption, and they are a fun thing to have. We've had them for, gosh, probably 20 years. You know what the most interesting thing about alpacas is? So these are not llamas. Llamas are the ones with the big banana ears, and you would never wear llama. It's not soft. Alpacas you can buy life insurance on. They're like racehorses. They're kind of in that crazy
Wow.
exotic animal space. And since I deal with a lot of life insurance, we have life insurance on our alpacas. So there you go.
I love that. I'm sure you have names for them and they
Oh
are
yeah.
probably part of the family. My husband raised llamas growing up, but yeah, I don't think they were so much part of the family.
Well, I will tell you that they're not as dog-like as we want them to be. And since I don't spend a ton of time with them, they're not super tame, but yeah, they're pretty unique animals.
Wow, that's
Beautiful.
fantastic. Yeah, well, tell us a little bit about what you do. You said you're a financial strategist, you have multiple books. Just give us a little rundown about you, Kim.
Absolutely. I have been helping people with their personal finances for over 30 years. I've worked remotely since the internet began, which I am so grateful for. And I've got a team of 10. We work in all 50 states, and we help America, like your basic person that is maybe in a job, maybe they have some investment real estate, maybe they have a business, but they're just your normal person, maybe making 50 to maybe two or $300,000 a year. Our clientele are typically young families, and we can help them make such a difference with what I call prosperity economics. It's an approach to personal finances that is different and sometimes, frankly, quite opposite of what you tend to find out there, which is max out your 401k and hope everything works well.
Right, wow, that's definitely needed and such an important niche that you're in there. So I think most people, they graduate from high school, they have no understanding of any financial anything, and they get a job and they do what you're saying, just kind of work and hopefully you save some for retirement, but there's just such a need for financial education out there. So what a great thing that you do.
Well, I've always been involved in the real estate space as well, just because of either owning land, owning rental properties, being involved with family members that had rental properties. And so a lot of my clients tend to also have rental real estate in some form. And it works really, really well with that alternative thinking, if you will.
So, Kim, I know when I've heard about privatized banking and lending, I've only heard about it in the form of lending. So like hard money loans that come in with higher interest rates, they're quick to close, but it costs. And I know you're using similar terms, but I think it means something different to you. Can you tell us more about that?
Absolutely. So there is a space, and it has been around for centuries, of private loans, hard money loans, individuals that have money, either individually or collectively, lending money to others that want to invest. And it is often done in real estate. Somebody's got time, somebody else has money, they'll put those two things together. And that's a space, and it's something that I'm aware of and have had some expertise in the past, certainly not something that I actively pursue, largely because there's another space, and it's often called privatized banking, that utilizes a whole life insurance policy, WHOLE, and builds up cash value, which is an asset that one can borrow against. And whole life insurance as a product, which has been around a couple hundred years, works very, very well with investment real estate. Because as we know, with investment real estate, and I'll just use that term, residential rentals, commercial property, whatever, land, it doesn't really matter. Investment real estate has emergencies to solve, which require cash, and opportunities to pursue, which require cash. And so I have always found that the more of a portfolio of real estate we build, whether it's a lot of land, a lot of acreage, a lot of individual rentals, whatever it is, that portfolio of real estate, as that gets built, one must come alongside it and build a portfolio of cash. So an alternative place to store cash instead of a bank or a money market is a life insurance company. So we're talking like Mass Mutual, Guardian, New York Life, these centuries old companies. And when you have that cash value to solve emergencies and take advantage of opportunities with your residential real estate, and then you can use your investment real estate, better word, to pay back the loan, which is why it's called privatized banking, that you have borrowed against your cash value from the life insurance company. Those two things can rise together. And then I want to talk about what happens at the end. But let me take a moment and just make sure that I've explained that clearly enough.
So can I ask you a question about that? So I think, are you borrowing from the premiums you've paid over the years, or are you borrowing from the cash settlement at the end if you died?
You are borrowing from the premiums and another term called paid up additions that you have contributed over the years, and it's called cash value. And then, yes, you're correct. That death benefit sits out there in the future, and we'll talk about that. But you are borrowing against your cash value from the insurance company.
And it's kind of similar to your 401k is sitting there and you take cash out and then you have to pay it back. I mean, in that way, it's similar because it's money that belongs to you but is sitting in a different pool, so to speak, right?
It's similar but not the same. And the reason it's not the same, and I'll explain quickly, is because, and you used good words, when you do that with a 401k, you are taking it out. They call it a loan, but you're removing dollars from that investment. With a life insurance, you are borrowing against. And we understand this term in real estate, don't we?
Yes.
Yep.
Yes, that's a critical difference. So if I have $100,000 of cash value at the life insurance company, and I borrow against it $60,000 to go do a down payment on a real estate deal, my $100,000 keeps on growing unaffected by that loan of $60,000, which is the insurance company's that is now going to go do the real estate deal, and then the real estate deal pays back the loan.
Fascinating.
Wow. This is mind-blowing because, you hear about all these different creative strategies, alternative strategies in real estate, because I think everyone, like you're saying, you have to find the money for the deals, right? If you don't have the money, you can't do the deals. And so I just love finding other ways that maybe people haven't considered to do some of these strategies. It's fascinating.
Yeah, it is. So I had a question then about, would your premium, your policy then be the collateral? So essentially, let's say that you still owed $60,000 and then you did die. They're saying, well, you have a cash payout, so we know that you're collateralized, basically. Is that correct?
You got it.
Okay, cool.
Technically, it is the cash value that's the collateral. Nevertheless, as you stated, let's pretend in that policy that I gave you an example of $100,000 of cash value, $60,000 of loan. Let's pretend that it was $1 million death benefit. If the person died, that $1 million would give to the family $940,000,
right,
and pay off the loan of $60,000.
Okay, so that would be paid off first, but if you went and paid that $60,000 off, then you're entitled to the full $1 million for your family.
You got it. And that $1 million is growing also. So let's a better example is that policy would have started at, say, $900,000. So you've got $100,000 of cash value and you've got more than that of death benefit. And that's a really misunderstood thing out in the marketplace. People think that whole life insurance death benefit does not grow. And people also think that when death occurs, that the insurance company keeps the cash value. Neither of those are accurate. And so we want growth, right? We want to grow as human beings. We want real estate to grow. We want our businesses to grow, our families to grow. Well, everything about whole life insurance grows. It gets bigger over time. So those premiums, and this is a challenge, right? When we think of the word premium, we think car insurance, home insurance, right? It's all cost. But the word premium with whole life insurance is really better thought of as a contribution. It's an asset that you're building. It's not an expense that you're paying and hoping to get someday.
So my life insurance policy that I took out 25 years ago, is that a different life insurance policy than when you use the word whole life insurance policy? Are those different policies than a traditional life insurance policy?
Probably. So most people, when they buy life insurance, they buy term insurance. And as the word implies, you purchase it for a period of time. So maybe it's 20 years or 30 years, right?
Right.
And then when that term of time is over, the policy doesn't exist anymore. It's just like car insurance. When we're paying for it, we have it. And when we stop paying for it, we don't have it anymore. And there's nothing wrong with term insurance. It's so important to know that, because there are a lot of people in that privatized banking space. You'll also hear the terms infinite banking or becoming your own banker. And there's a lot of different marketing terms that apply to the same thing. They negatively speak about term insurance, and that's not accurate. Everybody should have term insurance. If you have children, if you have mortgages, you should have term insurance. And you should also have whole life insurance. And yes, those are two separate products.
That is so good to know, because I think typically people are familiar with the term, or I've even heard of whole life insurance like it's a scam or it's not worth it, or you're not going to end up with the money you put into it. So it's so good to hear kind of the positives of it, or put some of those myths to bed, I guess.
Yeah. Whole life insurance agents are the redheaded stepchildren of the financial services industry. And it is funny. I've heard it all, Ponzi scheme, you name it, that all of those negative terms have been applied to that product, which, as stated, has been around for a couple hundred years. So somehow,
Right.
there's got to be some misinformation there.
Now, are there only certain things you can use it for if you're borrowing against your policy? Can you only use it to purchase real estate, or could you use it for maintenance or a really big upgrade or reno?
Yep, you can use it for anything you want. You are in complete control of that loan. The life insurance company does dictate the interest rate, and most insurance companies charge a fixed rate, which is usually around 6 or 7%. You might get a 5 or you might get an 8, but it's a fixed rate. And we know how valuable those are, right? And you can borrow against that life insurance 95% of the cash value. So think about it like a loan to value limit. And you have to pay the interest every year. You do not have to pay the principal every year. You should, over time at least. What I recommend to people that are doing investment real estate is, if you're doing a fix and flip or a land deal that's going to sit for a while and then pop, then don't pay your principal, just pay the interest every year. If you're doing more of a cash flowing deal where you've got a rental and you've got a person that's making your payments basically by giving you money every month, you're making your mortgage payment, of course, then also pay that life insurance loan every month, because that's the income that's coming from that residential or commercial real estate deal. But it's entirely up to you.
Well, that's really good advice. So they could just choose to either hold off if they needed the cash, or they can make small payments back. Now, if you don't pay it back, does that, if you're just paying the interest, the principal just stays $60,000?
Yep. As long as the interest gets paid. And I don't recommend that long term, because obviously you're paying interest, right? And there is definitely confusing language out there that the marketers and the YouTubes have gotten a hold of, and they talk about paying yourself and they talk about not paying the loan back. That's all inaccurate. You are paying interest to the life insurance company, and you do want to pay that principal back. But it could be over a 30-year deal. I've got a real estate case study that I do with life insurance where somebody was buying a little warehouse and they got it was actually a 27 or 25 year mortgage from the bank for the main mortgage on the property. And then they used a life insurance loan for the bulk of the down payment. Well, they are going to pay that life insurance loan back over that same 25-year period that they're paying their mortgage back. Totally fine.
How does it relate, the interest rate that you get from the life insurance company versus the bank rates right now?
So it really doesn't. It is a fixed rate. And to use that range, 6 to 7%, maybe a 5, maybe an 8, that's what life insurance companies lend at, period. It has been that way since the beginning of time. And it really does not move around. I mean, it has within that range, the adjustment, but all of us were alive when mortgage rates were 18%. The life insurance company was still in the 5 to 8 range.
Okay. And is there a minimum that you have to have contributed in order to be able to pull cash out?
So remember that you're borrowing against, not pulling it out, if I may correct your language.
Okay. Is there a minimum that you're able to borrow against?
If people are sitting here and going, well, that sounds great, but how many years does it take to get up to 120, 200,000? And I'm sitting here going, no, I need something next year. Is this a strategy that works for people that have planned 10, 15 years ago?
So it does work. It's like the old adage, when's the best time to plant a tree? 20 years ago, when's the next best time today, right? So the answer to your question is that there is no minimum. If you're in your 20s or 30s, you can start at $100 a month. If you're older, maybe in your 50s or 60s, you want to consider probably $500 a month the minimum. But I have lots of clients that are doing at, quote, the minimum. It is age-based. But I have lots of other clients that are doing $1,000 a month, $2,000 a month. Some of them are doing lump sums here and there. And there's some tax rules that you have to apply. But nevertheless, what you put in there and the growth, because it does earn dividends, is available for borrowing against at a 95% loan to value. So let's say somebody was depositing $10,000 a year, which is a little less than $1,000 a month. It would take them around 9 years to get to the 100,000 because, of course, there would be growth. And so my example is not unreasonable, even for somebody that's not doing, quote, a lot. So here's the thing. One of the most important messages that I hope people take from our conversation today is that we're going to live a long time. Like we used to think, 70, 80. No, we're going to live into our 110s, 120s, 130s. And so yes. And we're going to be healthy while we do it. That's the thing. This is not lifespan. This is health span. And there's so much proof coming out in today's world about that. The life insurance companies actually use age 120 on their illustrations. Okay, these are actuaries that have been doing this for hundreds of years. They know something.
Well, then I haven't hit middle age yet. I feel like I've got another 10,
That's what I'm
20
hearing.
years.
Exactly.
My midlife crisis needs to happen in another decade.
Exactly. And I'm one of those people believes if you're not having a midlife crisis every 10 years or so, you're asleep at the wheel, right? We should always kind of have those wake up calls every now and then.
We should.
Is there a health test, an exam, a cholesterol, benchmarks that you have to reach in order to get this life insurance policy?
Absolutely. Just like any life insurance policy. So if you are not healthy, you probably will not qualify. I mean, there's nuances without a doubt, but yes, you have to get approved. Thankfully today, they don't often come to your home and do the full exam like they used to. They can get medical records, they can do a cheek swab, simple things like that, but sometimes they'll do like a blood and urine sample. Depends on your age and it depends on the amount you're applying for. Because if you're 70 years old and you're applying for 5 or 10 million, which is common when you have people that are that age and have that level of wealth, right? So we need to come back to what do you do with that death benefit and your investment real estate. But nevertheless, if you're that old and applying for that amount, then there's going to be more thorough physical exam.
Yeah, understandably, because they're closer to death. One thing, though, you had mentioned when you when you borrow against it for real estate, can you borrow against it for other things too? And I'm assuming if you are borrowing it for real estate, they would want to do appraisals, or I mean, I'm sure there's a whole process.
Nope. That is your money. You are borrowing against your money. You are borrowing from the insurance company, but you are 100% in control of that loan. They do not
So it could
want
be
to
for
know.
a new boat or, whatever you kind of want it for. Oh,
You got it.
wow. I didn't realize that.
There's no credit check. There's no time frame, as we've already talked about, in terms of paying it back. And there's no limitations on what you do with the money. Now, I encourage people to utilize it for investing or just leave it in there. The cash value grows at a net rate. So like triple net, right? Real estate people typically understand that at about 4%. So for most people, because it's not taxed, the growth is not taxed, and that is after any commissions, cost of death benefit, all of that is already taken out, it's about a 6% return in today's world. So it's totally fine just to leave the cash value there and let it be that emergency opportunity fund. And here's the thing that I find so valuable. Most of our lives operate monthly, right? We earn income monthly for the most part. We pay our expenses monthly for the most part. It's hard to do real estate with monthly money. You have to have a lump sum, at least for the down payment, right?
Right.
So let the life insurance company make that transition for you, meaning you contribute to the life insurance company every month, you build up that lump sum so that then you can go borrow against it and do the down payment for your real estate. You're still going to get a mortgage at the bank, but you'll do the down payment with your cash value loan. And then you use the income off the real estate to pay back the cash value loan, and you do it again and again and again.
I love that. I love strategies you can just
Interesting.
reuse over and over. It's kind of like taking the equity from your home and using a HELOC or something to have quick money. I'm assuming the process to borrow from your policy would be fairly quick.
It is. It's about 3 days. You're borrowing against your policy from the insurance company.
So that's even quicker than trying to, get a HELOC from a bank because they've got to do an appraisal and check your house and everything. So that is a very quick option for people if they have it.
Have you seen any cases where they should have been putting their money, say, in a 401k versus this policy? Like, is there any weak areas that you could tell us about?
Yes, I love that question. So I'll answer your 401k question first, but then I'll elaborate a little bit on it. So to me, the best way to take advantage of 401ks is up to the match level only, MATCH. Everybody else talks about maxing them out, MAX, and I wholeheartedly disagree. Because when you max out a 401k, you basically are probably locking every savings dollar that you've got up into that plan that you cannot get at till 59 and a half and will not help you solve emergencies or take advantage of opportunities, because while yes, you can get a loan, there's hardship rules, there's all kinds of things. So MATCH on the 401k. Now, the downsides of the life insurance. It is not designed to be a short-term solution. So while we want to do it where we can borrow against it in a year or 2 years, that can work, especially if somebody has some lump sums to start it. But this is a product that is called Whole Life, WHOLE, for a reason. It is designed to be used for your entire life. And as I've stated, we need to be thinking a lot longer term about our lives and how long we're going to live. So the fact that you can borrow against it in the first 1 or 2 or 3 years, there's literally no limitation. Doesn't mean that you should. And so my suggestion for people is to first let it be your emergency fund. So put money in, build it up, let it be your emergency fund, whatever your family defines as emergency, right? Some people that's 10 grand, some people it's 100 grand, whatever number you want. Let the cash value be your emergency fund. And then after that, you build your opportunity fund. Here's why. And this is one of those downsides. If you are borrowing against it, just really leveraging that thing to the hilt, then you probably don't have an emergency fund. And you're going to probably lose that policy, because there will come a day when your interest is due, which is due once a year on a fiscal year, like based on whatever your policy date is, and you're not going to be able to pay it. So That's a risk, borrowing against it and not paying it back. And then the other risk is us human beings. Holy cow, do we want something for nothing? So we want to just put a little bit in it and have it do all these amazing things. No, the way to take advantage of it is to put as much in as possible. So instead of maxing out your 401k, right, just fund it to the match level, put the difference in the life insurance. Instead of prepaying mortgages, put the difference into the life insurance. Instead of depositing money into into money markets. Instead of depositing money into money markets, put that into the life insurance and let it be your position of cash.
What market factors influence how much money it's making?
None.
So it just makes 4%.
There is a dividend paid by the insurance companies every single year. It's not guaranteed to be paid, but it has a 100 plus year history of being paid. So I think we can be pretty confident in it. And right now today, so for the 2025 dividend, it nets down again after the cost of the death benefit, after the cost of the commissions, and after the cost of, it's a mutual company. So it's kind of like a credit union. So after all the administration fees, if you will, it's about a 4% return. And it's not taxed. So for most people, that's about a 6% rate of growth.
That's what I was going to ask. What are the tax implications of having, these policies?
None. So it's important to understand that your dollars that you're paying your premiums and your paid up additions with are after tax. So opposite of 401ks, right? But then it's never taxed again. Also opposite of 401ks, because a 401k, obviously we can't do investment real estate very well with it. Number one. Number two, it's all taxable when we take it out. Whereas the life insurance is not taxed along the way. It's not taxed when we die, and it's not taxed when we take it out as long as we're borrowing against it. Now, there's some nuances at the end when you're using it for income and that kind of thing where there will be some tax, but all along the way, if you're borrowing against it to do investment real estate, that is a not taxable transaction.
So, okay, let's say you're 70 years old and you want $5 million. There is not enough years that you could put enough in to get your $5 million. And so
Exactly.
term, they're banking the fact that you're not going to die. You're 20, you're taking out this term life insurance policy. It ends at 40. And so the goal is they take your money and you don't die. But with this, the ultimate end will be that you will die. So how do they get enough money in order to be able to pay out everyone if you're not actually ever putting $5 million into the system?
Yeah, it's the law of large numbers. This is how insurance works. It doesn't matter what kind it is. And so think about all the term insurance policies that cancel. Exactly what you said, right? All of the group life insurance policies that cancel, right? People work, they have it, and then they stop working, and then they don't have it anymore. All of those contribute to the profitability of the life insurance company. And the mutual companies that I'm speaking of, like Guardian and Mass Mutual and New York Life and Northwestern Mutual and Penn Mutual and I said Mass Mutual, those companies, again, around for almost a couple hundred years at this time, are able to take both, using the law of large numbers, term insurance and whole life insurance, and they price it appropriately. So I don't know if you've ever seen a term insurance schedule, but if you have, for example, 30-year level term, which is pretty common for people to buy, super low premium all during the 30 years. Well, if you want to keep it for the 31st year, it's way high. Well, all whole life does is the opposite of that. So term insurance, very little at the beginning, a huge premium at the end, which nobody ever pays. They just cancel it. Whole life has the larger premiums up front, and then you don't pay anything at the end. So people typically fund them during their working lives, 20, 30 years, something like that. And then they don't fund them during what people typically call retirement. But the death benefit stays in place because, as you stated, death is a guaranteed event. And so we're tying a guaranteed payment to that guaranteed event. And for those wealthier families, and I'll just go ahead and elaborate on this, especially with investment real estate, there's a paramount need to have the death benefit be there for them so that they can do things like charitable remainder trusts and proper transition of the asset to the next generation, et cetera. So that 70-year-old that is worth $5 million, his $5 million death benefit policy might cost $100,000 a year, and he's totally willing to pay it for, let's say, 10 years. He would pay it just for a certain period of time because of the freedom that tax-free $5 million coming into his estate upon death will create for him to pass his real estate on to the next generation in the most efficient way possible.
Fascinating. That's good.
Wow, and then his heirs would follow the laws for inheritance tax and different things like that. But technically, there wouldn't be any penalty to them unless it was over maybe a certain amount.
Well, remember, when we're talking income tax, there is no income tax on that $5 million death benefit. Mm-hmm. Now, there are absolutely estate tax issues, but there's not inheritance tax on the death benefit.
Oh, that's fascinating. Well, and so, I mean, you paid into it all these years. It's great if you want to use it to borrow from, but as a retirement option, probably not your best bet because you can't really pull it out like a 401k for retirement things because it's so interest.
It depends on what your other assets are. So if you have a lot of other assets, people use their cash value and the presence of the death benefit, both, as a permission slip, or you could think of it like a reliever, a pitcher in a baseball game. It's a permission slip if you have this over here to spend all your other assets. If you don't have any other assets, and the only thing that has worked for you, which happens sometimes, is this whole life insurance policy, then you can annuitize it. And at that point, you would get a guaranteed income for life. I mean guaranteed, and I mean for life, no matter how long you live. This is also part of the law of large numbers, right? And it would be partially taxable.
So there is a way to kind of fund your retirement or have income in your later years with this whole life policy.
That is
wow.
correct.
I didn't even realize all these advantages that come with it. It sounds like it's something that is just misunderstood and underutilized. And would you say that it's typically men or women that tend to utilize this strategy?
It's absolutely both. I do find that oftentimes women will understand it quicker. We tend to multitask well. Whole life insurance is definitely a multitasking tool. It can do a lot of different things. Swiss Army knife, if you will, has been an analogy that gets used a lot. But I have equal clients in both men and women. And of course, if there's spouses, then it's common, maybe one person does the finances, but you typically get whole life insurance on both parties. And you absolutely can purchase it on children, not nieces and nephews, but your own children. And that's a very efficient strategy to build wealth for that next generation while freeing them from all the typical limitations that 529s would have, or like if you remember the old uniform gift to minors accounts and all of that kind of thing, because you would own the policy. I bought insurance on my children when they were 1 and 2. I did it again when they were 6 and 7. They're in their late 20s. That's still my asset. I will give it to them when I'm darn good and ready, and not until. But now they've purchased their own and borrowed against it to do investment real estate with.
Well, that's
wow,
awesome.
That's fantastic. I just think it's such an underutilized area of cash that people can use to scale their portfolio. Now, it does take a little bit of planning, and you have to get started. Like you said, we all wish we started 10, 15, 20 years ago. But what advice would you give someone that's listening to this and saying, I want to use this, I don't know where to get started? What steps could they take to utilize this in their portfolio?
Think about that monthly capability, right? We all know that we should be saving more money. Saving is a verb, right? Not saving because you used a coupon at the grocery store. But the act of putting money away on a consistent basis. And so for people like me that have utilized whole life insurance their entire adult life, I didn't know anything about it. I was like you guys when I was 24, right out of school, and I'd had a job at a bank for a couple years. I had no clue what people were even talking about with the concept of life insurance, but I learned a few things not to do, like get involved with universal life and index universal life. That's a whole nother ballgame. But with whole life insurance, that capability over time, paying the premiums, and adding this extra portion that I mentioned called a paid up addition, enabled our family to build decent wealth just with the life insurance policies. And yes, we've borrowed against them and done real estate. As I've explained, we've borrowed against them and solved emergencies and taken advantage of opportunities within our companies. I'm in a 2-entrepreneur household. You know, we make payroll with them sometimes, pay it back during the lean years and green years, right?
Yeah.
So all along the way, I mean, we have 19 policies within our family and some of the key employees that we have. And these are not big policies. Some of them are $100 a month, $200 a month. Start with what you can do. And if you are a young family and you can save a couple hundred a month, 500 a month, something like that, start there and put the insurance on the main income earner. And then if you can save a little bit more than that, then put the insurance on both spouses.
Why do you think that there is maybe a bad reputation or that people think poorly of this idea?
It's very interesting. People in our generation, I'm kind of assuming we're all in our 40s and 50s,
Yes.
absolutely have a very negative connotation with it. And I think it's largely because Wall Street has come up and we all grew up with mutual funds really being, you know, in our early adult lives, mutual funds were first being introduced, and the whole 401k thing. I mean, that's only since 1970. So all of that wanted to pull money from any place it could, and whole life insurance, if you go back, so if you listen to people that are a lot older than us, or you listen to people that are a lot younger than us and don't really have all this Wall Street knowledge, they think whole life insurance is completely fine. There is a quote in a book called Pound Foolish. Can't think of the author right now. And the author, it's about a 2000 era published book. The author is quoting something from the 1940s, which said that financial planning is a mortgage and a whole life insurance policy. And that's all people used to do. You know, think about the movie It's a Wonderful Life. The guy has a life insurance policy, right? And he takes it to the bank and says, "Can you help me?" Right. So it's just misinformation. You know, it's like so much stuff out there. And the internet has helped it in some ways and hurt it in others because there's now even more misinformation. But I just go back to the fact that it's been around. I mean, some of these companies are literally 180, 190 years old. There's companies in Europe that are older than that. And it's a product that has just stood the test of time. So what I encourage people to do is be open-minded, figure out how you learn best. Do you like to read? Do you like to watch? Do you like to listen? And then reach out to me because I have, as you've stated, lots of podcasts, lots of books. And of course, all the books are on Audibles. So if you prefer to listen, then you can learn about it. And then you can decide for yourself whether you think that it's all bad or it's a Ponzi scheme or it's, you know, the commissions are high or all the myriad, it's a bad return, you know, all the myriad of negative things that are out there. You decide for yourself with an open mind and a willingness to learn, and then reach out to somebody that can help you with it. And I'll just end that little tirade with this one statement that I want to make again, which is please be clear that there's term insurance, which is awesome. TERM, good, get some. There's whole life insurance, WHOLE, good, get some. There's universal life, index universal life, variable universal life, anything that has the word UNIVERSAL, not so good. Please be careful before you choose to get some.
Why is that not good, would you say?
Well,
succinctly, I guess.
Yep. Not an easy one, but I can do it. If you looked for an analogy at a trailer park, a mobile home, right? Like I've lived in one. I lived in one for 3 years while we built our house. There is absolutely nothing wrong with them. They put a roof over our head, and I'm not making a political statement or a judgment call about this at all. I'm just sharing an analogy that will help you understand the difference. But the fact is, a mobile home, a trailer, is not built as well as a brick and mortar house on a cement foundation, right? We call them both homes, but there's a huge difference. Whole life is the brick and mortar home on a cement foundation. And universal life of any sort is a mobile home. They're both life insurance, but that's where the similarities end.
So I'm clear about whole life insurance. You don't have to come up with the amount of the total policy. There's going to be a percentage. Is that a set percentage? Is it a 10%? Yes. Or what is the percentage that you have to? It's age-based,
but if you're really looking for a number, it's about 5% of your assets.
Oh, I see.
So especially the wealthier people, like we were talking about, that are older, they just need to skim the cream off the crop, take about 5% of their assets, and over about a 10-year period of time, they can buy, as I was sharing, a large death benefit that's going to be 95% of their 5%. It's going to be much, much larger. Somebody that's younger and that's earning income, they want to think about it in terms of 5 or maybe 10% of their income. And like we're all told to save 10 or 20% of our income. Most of us don't do it, but we know that we should. Well, 5 to 10% of that should be your life insurance premiums.
Interesting. And how does it compare with all these companies? You're saying different names. Are they all created equally? Are there some you recommend, some you should stay away from?
It's a great question. As long as you're talking whole life, you want to be involved in what's called a mutual company. And there's about 20 of them. So I've rattled off some names. A mutual life insurance company has been around well over 100 years, has paid a dividend every single year. They sell whole life, WHOLE, and there is relatively no difference between the 20 or so that operate in America. There's different ones in Canada. But that is such an important question because people want to, is it Guardian or Mass Mutual? It does not matter. Is it New York Life or Northwestern Mutual? It does not matter. Don't spend your time on that. Spend your time learning how the product works because, really, we're talking a product's been around 200 years. You really think somebody's got a better mousetrap? Probably not. So spend your time learning how the product works and spend your time getting comfortable with the person that's going to help you because whole life as a product cannot be purchased on the internet by yourself. There's literally no such thing as no commission whole life or, any kind of DIY space. It must be purchased through an agent that is going to earn a commission. And so utilize that person's knowledge, be comfortable with that person. You're going to own this product the rest of your life. And while absolutely over time you can learn all that you need to know so that you're not relying on your agent, you need to rely on your agent in the early stages. And so you need to be comfortable with that person and the way that they communicate and their team, if they have one, and all of those things.
Perfect.
It's really good advice. I really like that.
So you have several podcasts, and one of them is about 3 generations. Nobody can keep their wealth for 3 generations or longer. Not nobody, but that it's very difficult. What would you say is the problem?
We spend too much, and we have 0, if not -3 on a scale of 1 to 10, financial knowledge, right? And this is so sad in a country like America that in today's world, the kids in high school, if they have a financial class, they're taught how to trade stocks.
Yes.
Okay, that's one tiny piece. They're never taught about investment real estate. They're never taught about whole life insurance. They're probably not taught about mortgages. And furthermore, if we get out into the adult world and we start to get our heads up and realize I need some financial education, we tend to go to the companies. Well, okay, let's think about where that education is coming from. The companies are going to share strategies with us that benefit them. And so we're so uneducated around money, which is horribly sad in our world. But it goes further than that. Even if we may feel like we have financial education, we're not financially competent. And again, it's a lot because we are so driven in our material world to buy things. And I love Amazon, but it is crazy worse now because we can buy things so quickly on our cell phones, and it's just really taken things over. Now, in a way, like we live way out in the country, Amazon's been super helpful for us because I probably spend less now because I don't walk into a store.
Right.
And down the aisle, I need this, I need this, I need this. Oh, this is on sale, I'll get that. So Amazon can actually be helpful. But the point is, we spend too much money. And so saving as a verb, to build up savings as a noun, is the most boring thing to talk about in personal finance. And your typical financial planners, your financial advisors, none of those people want to talk about savings because it doesn't earn them any money. They want to talk about investments, right? America needs to save as a verb. Basic, boring. If you don't know what else to do with it, put it in a savings account at a bank or a credit union, and then start to learn about investments and investment real estate and whatever fills your boat in terms of alternatives. But save as a verb, and then store savings as a noun. First, to solve emergencies, and second, to take advantage of opportunities. And again, our lives work monthly, so we got to get in a habit of saving monthly and build those dollars up so that then we can take advantage of opportunities, which typically cost lump sums.
That's interesting. In 1988, I had Janus Mutual Fund International, and it was $25 a month. And I had to work so hard to have that $25 every month to go in there. I was like 12 years old. Anyway, that idea is true, that we usually, if it's in our bank account, we'll spend it. So to have something that is either automatically pulled out or another bill we're paying, but actually is going into a savings, I mean, that is a really good suggestion. I think a lot of people talk about having a higher yield savings account that they put the money in, but I can see why this dollar might stretch further if you're actually able to leverage it for a loan, instead of just the finite number that you have in the savings account, but actually to be able to, as it's growing, to be able to pull money out, but then it's still there to be able to count later. So I mean, it sounds like a pretty smart thing to do. I had never heard about this. This is a really interesting idea.
Well, I'm so glad to be able to share it with you. And I will leave your listeners with a tip that has nothing to do with life insurance. And that is exactly what you were talking about. And it is to put our earned income into a different account than our checking account where we pay our bills. So a lot of people do it the other way around, right? They put their money in the checking account and then they try to move some to savings. And maybe they do. But the savings ends up being a put and take account, right? It just kind of morphs back into the checking account. If we will stop doing that and put our earned income into a separate account, it's the principal, the actual hard dollars, as in the financial term principal, that matters way more than the interest in the early phases. So earn 3% or whatever, fine. Don't worry about what interest rate you're earning. Just put your earned income, whether it's investment income, rental real estate income, W-2 job, 1099 job, bonuses, it doesn't matter. Put it in a different account. And then set an automatic payment twice a month to move from that savings account to your bill paying account to pay the bills. Budgeting doesn't work. I mean, nobody has ever worked with budgeting and had it actually impact them more than 2 or 3 months. And so this strategy that I'm sharing with you will work. And on the special page that I've made for your listeners, which we'll include in the show notes, there's actually a white paper, a PDF download about this strategy a little bit more thoroughly. But if you don't want that, you just want to make one change in your life, put your earned income into a separate account, use the separate account to pay yourself into your checking account a couple times a month. Because in the year 2025, we actually are going to get 27 paychecks. Those of us that are paid every 2 weeks, and we normally get 26. So what happens to that 27th paycheck? What happens to your tax refund when you get it? What happens when you get a bonus? What happens on the months that there are 2 paychecks and sorry, three pay, the pay periods are all mixed up. I got my math wrong. You know what I'm talking about.
Yes.
It happens
It gets
at least
spent
twice a year, right? What happens when we stop funding our 401k? What happens when we get past Social Security limitations if we have that kind of income? What happens to all that money?
Usually wasted.
Spent. Amazon.
Wow, Kim, this has been so packed with so many nuggets, so much information. I feel like we could just keep talking about this forever, and I appreciate all of the knowledge and experience that you have brought, and hopefully our listeners are able to hear. It's new to me too, this new avenue of possibly funding investment real estate. It's fantastic and very, very useful. And as you had mentioned, you have a document prepared that, yes, we'll include in the show notes. So thank you so much for sharing that with us. And then if people want to get a hold of you, how can they best do that?
So the special page that we'll prepare for you, which is prosperitythinkers.com, and I think it's /landlady, we'll have the link in the show notes, is really the best way. And then from there, the website itself obviously has lots of information. And as you stated, there's plenty to learn from in terms of books and podcasts and videos and that kind of thing.
Yes, perfect. And if anyone's looking for books authored, it's Kim Butler and her podcast. What's the name of your podcast?
The Prosperity Podcast.
Prosperity Podcast. So check her out there too. I want to go look and hear these different episodes, and especially, what Rachel mentioned, there's one about how wealth is lost after the third generation. So fascinating stuff, and I just appreciate you so much coming. If you'd like to submit topic ideas or questions or concerns, you can email us at landladybosses@gmail.com. And remember, no one manages your properties as well as you.